Welcome to Countouts. In this lesson, we're going to be looking at the issue of shares. What happens when an entity issues shares, when they allot shares, when they allocate shares to specific shareholders, and how do you journalize them? We're also going to look at the reasons why a company would issue shares, to whom they issue the shares. We're also going to look at aspects where you have the share issue costs and where you have an underwriter for the shares that are being issued. So firstly, how do companies raise money? What do they do in order for them to get the money that they need for whatever they need to do? Maybe they want to expand on their operations, or they're just starting out the business and they would like some funding to be able to operate. Well, publicly traded companies raise equity or money by selling shares to the public. They do so by issuing a prospectus which specifies details of the company and their share offer to prospective investors. So what do we mean here? Well, if a company is publicly traded in South Africa, they trade on the JSE or the Johannesburg Stock Exchange, and that would allow them to raise equity by issuing shares to the general public. Now, they do so by issuing a prospectus, and this basically tries to win investors over, to show them what are the details of the company and the shares that they are offering, so that the investors can be interested in buying the shares in this company. So when we're looking at the issue of shares, we're mainly looking at publicly traded companies. If a company is not trading on the stock exchange, then they can't issue shares to the public, and so they do not have access to the pool of funds which are available out there by those who would want to invest in the company. The prospectus also contains details of the price per share, number of shares on offer, and the closing date for application. And so it will say this is how much each share is being sold for, and this is the number of shares, or the total number of shares that we are issuing to the public, and until when you have to apply for these shares, meaning the closing date at which you can apply and make payment. And so why would the general public or potential investors buy shares in any company? What is the reason behind that? Why would you want to buy a share in a company? Well, because of dividends. What is a dividend? A dividend is a portion of a company's profits that are distributed to its shareholders. Investors who prioritize income generation often seek shares that offer consistent and attractive dividend payments. And so many who would be investing in specific companies may want to invest because they want to get a regular dividend that the company is issuing. Remember, when a company makes its profits, it will decide whether it wants to issue a dividend, but it's not always guaranteed. Some companies do not issue a dividend and haven't issued a dividend in quite a long time. Others issue a dividend 1 year and they would go for a few years before issuing another dividend. And others are very regular. They would issue dividends consistently. And so those who want dividends, or those who want to generate an income from their investment on a regular basis, will seek to buy shares that offer consistent and attractive dividend payment. That's what we mean there. What is the other reason that one would invest in the shares of a company? Well, because of capital gains. What do we mean by this? Well, this is an increase in the price of a share over time. And so if I bought a share 5 years ago for 10 Rand and the share is now trading for 50 Rand, I can now sell that share and get my 40 Rand profit. So this is mainly ideal for investors seeking primarily increase in share value rather than regular dividend income. So if I don't care about receiving a dividend regularly, but I want the capital gains on my shares or on my share price to go up over a specific period of time, then I will want to invest in a company which will likely result in capital gains. Now, those who want to invest in the long term would be looking at this one here because of capital gains, or those who want to invest in very small companies that are potentially going to grow very rapidly and be able to increase the share price. Otherwise, for those who want stable dividends, they will likely invest in companies that are already stable. They have reached their peak. They're not likely to grow at a rapid pace, just like new companies are likely to do. Of course, you take into account the risks involved in investing in new companies which may go bust or may not be able to grow as one would anticipate. So these are the reasons why one would buy shares: to get dividends and also for capital gains. You may invest in shares for both reasons, for dividends and capital gains, but otherwise one would primarily be zeroing in either on the dividends, that is getting consistent income, or capital gains, that is the long-term growth of my share price, so that I can sell it later on for a profit. So this is how companies raise money and why one would consider buying shares in a company. Now, when you're dealing with share capital, you will note that there is what we call the authorized share capital and the issued share capital. What is the difference between the two? Well, let's quickly look at the difference here. And it's very important for you to know the difference, especially when you're dealing with journal entries for the issue of shares, the allotment of shares. There's usually confusion about what they mean by authorized shares and issued share capital. So this one here should clear the confusion. Authorized share capital is the maximum number of shares that a company is legally allowed to issue to shareholders as per its constitutional documents, such as the Memorandum of Incorporation. So basically, this is what has been agreed upon, that this is the total number of shares that the company can issue. Now, if you see authorized share capital to be 10,000 shares, it does not mean that the company has issued 10,000 shares or it has received money for 10,000 shares. It means at the maximum, the total number of shares we can issue as a company is 10,000. So it just shows you the maximum. Usually you will not do anything with that information where they tell you this is the authorized number of shares, unless they specifically ask you a question relating to that. But when you're doing journal entries, authorized number of shares is the total number of shares that the company can issue. So they're just giving you that information. What about issued share capital? Well, issued share capital is the portion of authorized share capital that a company has already issued or allotted to shareholders. It refers to the shares that have been sold to investors or are otherwise allocated. The issued shares can be less than or equal to the authorized share capital. So in simple terms, issued share capitals are the ones which have been issued to shareholders already. These are owned by the shareholders of the company, those to whom the shares have been issued. So I hope you can see the difference here. Authorized share capital, the maximum number of shares the company can issue. Issued share capital, the actual number of shares the company has already issued to the public. So in other words, these are the number of shares that the company has issued in the stock exchange, for instance, for publicly traded companies. Now you can see here there's a statement that says that the issued share capital can either be less or equal to the authorized share capital. Of course, that should make sense, because we can't have issued share capital being more than the authorized share capital, because authorized share capital is the maximum you can issue. Usually you will have issued less than the authorized share capital, or at times equal to the authorized share capital. So if you've issued exactly what you're authorized to issue, then you can't issue any more to the public at all, unless of course it's approved by the company to change the authorized share capital to another amount. But when you're issuing shares, who are you issuing the shares to? Well, let's look at that. Who are the shares issued to? Well, firstly, the incorporators. Who are these? These are those who are responsible for initiating the process of incorporating a company. They are the initial organizers who take the necessary steps to legally establish a corporation. In other words, these are the people who started the company. We call them incorporators. Now, you will note that when we will do the general journal accounts and the shares are being issued to incorporators, those who started the company, you will see how you account for them. So we'll look at that example shortly. Who else can the shares be issued to? Well, we've already looked at this. The general public. When you issue the shares on a stock exchange, you will issue them to the general public. They buy shares when a company lists them on a stock exchange. When you have put out your prospectus and you're saying these are the number of shares we are issuing at the specific price, then the general public can participate in buying the shares. This could be individuals, it could be other companies or other organizations and entities who may buy shares in a specific company. It could also be the government buying shares in a specific company. Who else can buy shares? Well, existing shareholders can buy more shares in addition to what they already have. They can be issued shares as part of a rights issue or capitalization issue. If you'd like to learn more on that, you'll find a link in the description below. We'll look at the rights issue and capitalization issue. But basically, this is you issuing your shares to your existing shareholders. You may even prioritize them to say, guys, we're about to issue shares to the public. If you'd like to buy shares, you're welcome to do so. Who else can buy shares? Well, company directors or the directors of the company. They are elected or appointed to oversee the management and operations of the company and can be issued with shares upon approval by shareholders. So these are those who are appointed by the shareholders to run the company, and they may be issued with shares. We know that when directors own the shares, they will make sure that the companies operate optimally, because as the company does well, so do they, in terms of their shares being protected and their share prices going up. So these are the individuals or entities who may own shares or who can buy shares in a specific entity. So now we're going to do journal entries to show how we account for the issue of shares to incorporators and to the general public. So firstly, let's look at the steps for the issue of shares to the public. And you're looking specifically at the steps that you take when you're doing the journal entries for the issue of shares to the public. When you want to issue the shares to the public, what are the steps that you take, and at what point do you record your transactions? Well, let's look at this. The first thing that you do, of course, is you have the date of offer and issue of prospectus. The date that you are offering your shares to the public and you're issuing your prospectus. Do we do anything at this point? No, we don't. No journal entry is passed, right? This is just the date that you are announcing your offer and you've issued your prospectus for potential shareholders to be able to see that these are the shares on offer and I can choose to buy or not. So at this date, you don't do any journal entry because no transaction has actually taken place. The second thing that happens there is the date when applications close. What do we do in this case? Remember, when applications close, no one can buy shares at that particular point. So we do a journal to record the receipt of application money. Remember the dates when application close. That's when we'll know, okay, how much money have we received in total and for how many shares. So we have to do the journal entry to record the receipt of application money. These are those who have applied for shares in our entity. All right, so you do a journal entry at that specific date when the applications are closing and you have the information of how many bought the shares. The third event that you have when you issue shares is the date when allotment is made and share certificates are issued. What do we mean by this? Well, this is the date when you're allocating the shares to the shareholders who've just bought the shares in the company, and you issue them with the share certificates to show that they own these shares in the company. We definitely have to pass a journal entry at this point. We are recording the issue of the shares. This is when you have now issued the shares to the shareholders and you record the classes of shares that you've just issued. The fourth event that we have here is the date of refunds for unsuccessful applicants. That is, if it's applicable. Remember, sometimes you may have an oversubscription of shares. If you're only issuing 10,000 shares and you receive 12,000 applications, you will have recorded that in number 2 above. But in number 3, you're only going to account for the 10,000 that you had issued. So in our example where you issued 10,000 shares and you received 12,000 applications, the 2,000, of course, you will have to refund the money for those shares. So that is the journal that you will pass to record the excess payment beyond the offer value. So if you've received applications for more than you offered, then you have to refund the balance. And this is how you go about doing the journal entries for the specific events relating to the issue of shares. Now let's look at practical examples where we will apply what we've just learned here. But if you can remember these steps, it will make it quite easy for you when doing journal entries. So let's look at this example. So the first example we have here is where the company has issued the shares to the incorporators. Remember, the incorporators are those who were involved in the setup of the company or in starting the company. So let's look at the example. Palm Gold Limited was incorporated on the 1st of December 2023 with the authorized share capital as 200,000 ordinary shares and 80,000 10% 6 Rand preference shares. I'm sure we already know what authorized share capital is. Of course, these are the maximum amount of shares that the company can issue for each class of the shares, ordinary shares and preference shares. The incorporators approved on December 5, 2023 to acquire 100,000 ordinary shares priced at 2 Rand per share and 35,000 10% preference shares priced at 6 Rand per share during their company meeting. Payments were completed by the 7th of December 2023 and the corresponding share certificates were provided. Record the above transactions in the General Journal of Palm Gold Limited for December 2023. So again, how are we going to go about doing this? Well, let's go from the top and see what do we have to record here. Remember, we're recording relevant journal entries pertaining to the issue of shares here. So it was incorporated on the 1st of December 2023 and these are the authorized shares. We don't do anything, of course. There is no transaction with the issue of shares here. So we're just given the information on what the authorized share capital is. But we are told here that on the 5th of December, it approved to acquire 100,000 ordinary shares and 35,000 preference shares during their company meeting. Okay, so here's something that we need to bear in mind. Remember, these are the issue of shares to the incorporators and not to the public. We've already looked at what we're talking about when we're referring to the incorporators. So remember, the previous steps that we spoke about specifically relate to the issue of shares to the public, which is the most common scenario. So here, when we're issuing the shares to the incorporators, when it has been approved to acquire a specific amount of shares and a specific class of shares, either preference or ordinary, for instance, then we have to record it because it's been approved. That means a transaction has taken place right there. So whenever you're told that the company approved to issue the shares to the incorporators, or the incorporators are the ones who are approved to issue these shares, then you have to record it because the transaction has taken place at that point in time. Remember, here you're not issuing the prospectus because you're not issuing shares to the public. That is why you'll not see information relating to the prospectus when the shares are being issued to the incorporators. Okay, so I hope that has made sense. Another thing to clear out here is that if you do not know your debits and your credits, you will struggle with a question like this, or whenever you have to do journal entries and you're not quite familiar with what accounts you debit, what accounts you credit, and you're not sure how debits and credits work. It's important for you to go back to the foundation, have that understanding, and then come and apply it here, because you won't know why we're debiting a specific account, why we're crediting a specific account. So we have a link in the description below with lessons on the debits and credits and how you remember what account we're debiting and what account you are crediting at what point in time. So here we're issuing the shares to the incorporator, but you'll notice here that the payment is not being made at that specific date, but we still have to record it here. So what are we going to debit? We're going to debit incorporators. All right, incorporators, meaning it's a receivable. We're debiting it because it's money that we're due to receive. That means the incorporators are our debtors in this sense because they owe us the money. So we debit incorporators, right? They're our debtors, and then we credit the shares that we are issuing. In this case, we've got ordinary shares and preference shares. So that's exactly what we're going to do. All right, remember, ordinary shares, that is equity, and preference shares, that is the equity of the business. That is why we are crediting them to raise the issue of shares basically in our books, so to show that we have just issued shares in our books. All right, this will appear in our balance sheet when we prepare the annual financial statements. Okay, so what is the amount here? Well, we've got the 100,000 ordinary shares at 2 rand per share, so 100,000 times 2 rand, that gives us 200,000 rand, and we've got 35,000 preference shares at 6 rand, so 35,000 times 6 rand, and that will give us the respective amount for the 2 shares, and then the total of the 2, of course, is what the incorporators owe us. So this is exactly how it's going to look. We put our date there, 5th of December 2023, and then our detail there, debit incorporators, that's our debtor, that's where we're debiting it. If you look at those lessons in the links in the description below, you would know that we debit our debtors, or those who owe the company money, and then we credit, of course, our ordinary share capital and our preference shares. All right, and we've got the total amount for the 200,000 plus the 210, that gives us 410,000 rand. And the description there, or the narration there, is allocation of shares to incorporators. Remember, there is no specific wording that they would want you to use for the narration, as long as you're speaking to what is happening in the transaction. All right, I hope that was clear enough. That was easy enough. This is what happens when you issue the shares to the incorporators. Whenever you've done that, this is the first transaction that you would pass, and then the second one that we need to pass, of course, is the one relating to the payment that was received. Remember, when we receive payment, we have to credit our debtor, in this case, which is our incorporators. When money is received, the easiest account we can ever identify is bank. Whenever there's movement of money, either in or out, we know one of them is bank there. But since money is coming in, we're debiting our asset. So we're going to put our date, the 7th of December 2023, and then we debit bank money coming in, 410,000 rand, and then we credit our debtor, incorporators, 410,000 rand, because they've just paid us. So we are removing that as a debtor from our books. And of course, our narration here is the receipt of payment for shares allocated to the incorporators as per motion. Again, it doesn't have to be the same as mine, but as long as you're speaking to what has just happened. And that is as easy as that. I just wanted to show you quickly here what happens when you're issuing the shares to the incorporators or to the founders of the company. Now, in a scenario where they are paying you on the same day that the shares are approved to be given to them, meaning that if we're receiving the money on the 5th of December, the same date that the shares are approved for them, then instead of debiting incorporators on the first journal entry, we'll just debit bank, and then of course credit our ordinary share capital and our preference shares. That means we won't have a second journal entry here because the payment would have been received on the exact same date. Otherwise, in that scenario, you could also have the 2 journal entries, but the date is going to be exactly the same. right? 5 December for both journal entries. That's if the payment is received on the same day. It will still capture the exact same detail and it will have the same implication in your books. But since, of course, payment is only received later, that is why we have the two different journal entries with the two different dates. All right. Now let's move on to the most popular or the common scenarios that you would have where you are issuing the shares to the public, where we will now apply the steps that we had mentioned in the previous slide. So let's have a look at this example. So here's the example. When you've issued the shares to the public and you have an oversubscription of the shares, what would you do and how would you journalize it? It's quite simple to do this, especially if you follow the steps that we've just spoken about. But quickly, just to mention that you'll have three scenarios when you're issuing the shares to the public. Obviously, you indicate how many shares you're issuing and they will make application for those shares before the closing date. What you will likely have is oversubscription of shares, meaning more people have applied for the shares than are available. So if you're issuing 10,000 shares, for instance, you might have 12,000 applications. So that is an oversubscription. And what do you do in that instance? We'll look at this particular example to see how we would handle that. Or you might have exactly the number of applications as the number of shares being issued. So that's where you neither have the oversubscription or the undersubscription. But the third option is where you have undersubscription, where you, let's say, are issuing 10,000 shares, but you only received 8,000 applications. That's an undersubscription. We're going to look at that in the next example. But what is oversubscription? Well, I've just alluded to that. This occurs when the demand for shares in a company's offering exceeds the number of shares available for purchase. In such cases, more investors apply for shares than the company has available to issue. And so, of course, you can't increase the number of the shares that you will issue just because you have more applications for the shares than you had initially issued. You would have to refund that money, and we'll see that just now. In instances of oversubscription, where there is an excess of funds from surplus applications, companies usually return the extra money to the applicants, as I've just mentioned, and you will have to journalize that as well. This refund process ensures that those who applied for shares beyond the available quantity receive reimbursement for the surplus funds they submitted with their applications. The refund is usually issued promptly after the allocation of shares is finalized, ensuring fairness and compliance with regulations regarding excess subscription funds. Like I said, a company cannot just decide to say, hey, we've received more applications, let's issue more shares for this one here. No, you're only issuing what you have welcomed applications for. So if you've said in your prospectus, I'm issuing 10,000 shares, that is the maximum that you're going to issue in that particular application. So whatever money you've received extra, you'll have to refund to the applicants. Otherwise, for the ones that have applied on time and you've issued them with the shares, of course, you're going to allocate to the particular new shareholder. So let's look at an example where you have oversubscription and we see how to journalize this. We'll move a bit quicker because we have mentioned the steps and we've already looked at that previous example where you issued the shares to incorporator. So it's not going to be anything complicated. So here's the example. Pamgo Limited was incorporated on the 1st of September 2023 with the authorized share capital as 200,000 ordinary shares and 80,000 10% preference shares. Right? Remember, they mentioned that is authorized share capital. I'm sure we're already making sense of that. You need to underline that. Are they talking about authorized or are they talking about issued share capital? You always need to know which one you're dealing with here. The company released the prospectus on the 10th of September 2023, presenting an offer of 30,000 ordinary shares priced at 2 Rand per share and 15,000 10% preference shares at 10 Rand per share. The application deadline was set for 15 October 2023, with the allotment date scheduled for 30 October 2023. As of the end of business on 15 October 2023, the company received 33,000 applications for ordinary shares and 20,000 applications for 10% preference shares. On the 30th of October 2023, shares were allocated and share certificates were distributed. Any surplus applications were refunded on the 5th of November 2023. Show journal entries to record the above transaction. So again, if we go back to the steps that we had mentioned, we need to note when we have to record journal entries and when we don't. Okay, so let's go a date at a time. We told that the company released the prospectus on the 10th of September 2023. Now, what do we do? What journal entry do we record at that point in time? What I'd encourage you to do here is using those steps that we had initially mentioned as to when you record what journal entry. You can attempt this question, and then once you're done, you can press play and you can grade yourself. You will better understand it than just following along, as I always mention. So go ahead and do that. All right, hope you've attempted it. Now, when you look at those steps that we had mentioned as to what happens when you issue shares to the public, remember, we're going to follow the dates of transactions or the dates of what's happening, right? So the first date we're given here is the company released the prospectus on the 10th of September 2023, presenting this offer. So what journal entry do we pass at that point in time? Well, if you attempted the question, I'm hoping you knew that you don't record any journal entry, or you don't pass any journal entry in this case. The date of offer and issue of prospectus, no journal entry is passed, as we had mentioned and explained earlier. So you don't do anything for the 10th of September 2023. What about the application deadline of the 15th of October 2023? Well, of course, you will pass the journal entry on the date when the applications close. So let's look at that. You will have noticed by reading that you have an oversubscription here, because for the ordinary shares you presented the offer for 30,000, but you got 33,000 applications, so you got more money than the availability of shares that you were offering. And for the preference shares, you were issuing 15,000, but you got 20,000 applications. So of course there is an oversubscription for both classes of shares. So where do we begin? Well, let's ask ourselves, how much money did we actually receive in total for the applications for ordinary shares? Let's start with that. Application for ordinary shares, we've got 33,000 that we received, and we multiply that by the share price of our shares, and we're told up here that we're presenting an offer for 30,000 ordinary shares at 2 rand per share. So how much did we receive in total for ordinary shares? 33,000 applications times 2 rand, and it gives us 66,000 rand. So that is how much money came in from the applications. Of course, we know that it's an oversubscription, but we're going to deal with that. What about preference shares? How much money did we receive? Well, it's easy. We received application for 20,000 preference shares, and how much is each preference share worth? Well, it's worth 10 rand, or we are selling each share at 10 rand per share. So it's 20,000 shares times 10 rand, that gives us 200,000 rand. All right, so that's the first thing we do. We note down how much we actually received from the applications. And now that we have that for each class of the shares that we had offered, we can record what we have just received. So obviously, if money came in, you should know by now what you debit when money comes in. Of course, you debit bank. So we're going to debit bank with the total of the two, right? 200,000 plus 66,000 rand. That gives us 266,000 rand. And then what we're going to credit is application and allotment, one for ordinary shares and another one for preference shares. And that will be our first transaction done. So we put down our date, 15th of October 2023. Very important, the date here, because we're told the application deadline was set for 15 October 2023 with the allotment date scheduled for 30 October 2023. And we are further told that as of the end of business on 15 October 2023, the company received this application. So of course, we put that at our date that the money came in, or that we confirmed this is how much applications we've received. So we debit bank and we credit application and allotment for each class of shares. What is our narration here? Our narration is payments received for share applications. Again, you might word it a bit differently, but as long as you're mentioning what you have just journalized. That is easy enough with the first one. What is the second thing that we do? Well, we have to remember the steps that we had spoken about earlier as we are doing these journal entries. What is our second journal entry? We know the events that happened on the 15th of October. That is the date when applications closed, and we did pass our journal entry. When else do we record a journal entry? Well, let's see what other information we're given. We're told that on the 30th of October 2023, shares were allocated and share certificates were distributed. Do we record a journal entry at that point in time? Of course we do. Remember, point number 3, we record the journal entry on the date when allotment is made and the share certificates are issued. So we'll have to record the issue of shares right there. So how do we do that? Well, I'm sure you would know that when we are allocating the shares to the shareholders, we're going to debit what we had initially credited here. So application and allotment for both classes of shares, we're going to debit them, and then of course we credit our classes of shares, ordinary share capital and preference share capital. But what amount are we going to record these classes of shares at? Are we going to record them at 66,000 rand and 200,000 rand for both ordinary shares and preference shares? No, we are not. Remember, we can only allocate the shares that we had offered, right? The amount of shares that we had offered. Remember, here's an oversubscription. We received application for more shares than we actually offered. So we're only allocating the shares that we had offered. Look at this. We had offered 30,000 ordinary shares. That means that's the only amount we can allocate, the 30,000, and not the 33,000 shares. And for preference share capital, we had offered 15,000 preference shares, but we received application for 20,000 shares. So we're going to only allocate the 15,000 that we had offered. So it's going to be 30,000 ordinary shares, and of course we'll multiply that by 2 rand. That's going to be 60,000 rand for ordinary shares, and then it's going to be 15,000 preference shares, and of course we'll multiply that by 10 rand per share, and it's going to give us 150,000 rand. Very important for you to understand that and to make sense of that. If you have oversubscription, you're only going to allocate the number of shares that you had initially offered, all right, not everything that you received, or not all the money that you received. So here's how it's going to look. We're going to debit application and allotment for both classes of shares, ordinary and preference, and then we're going to credit ordinary share capital, 30,000 shares times 2 rand, and 15,000 shares times 10 rand for preference shares, and it will give us those amounts: 60,000 rand for ordinary shares and 150,000 rand for preference share capital. All right, and the narration there is allotment of shares to the public. Okay, so that's when you have allocated the shares to the shareholders. So now what is happening to the difference here? You will note there's a difference here because we had credited application and allotment 66,000 rand, but we are only debiting 60,000 rand, so there's that difference of 6,000 rand, and for the preference shares there's that difference of 50,000 rand. Of course that comes from the excess application that we had received, so we need to refund that money back to the shareholders. All right, so we need to give that money back to the shareholders who applied, but we were not able to give them the excess shares. And that is step number 4. Remember, step number 4 states that we record a journal entry on the date of refunds for unsuccessful applications, if applicable, and of course if you're dealing with oversubscription, it is applicable here. So let's record that. We're going to debit application allotment ordinary shares, and it's going to be the excess, which is the 3,000 rand, right? 33,000 applications received minus the 30,000 that we're offering, so we received excess applications of 3,000 shares. So 3,000 times 2 rand, that's 6,000 rand, and for preference shares it's 5,000 because we're offering 15,000 shares and we received application for 20,000 shares, so it's 5,000 times 10 rand, which is 50,000 rand. So we're going to debit application and allotment ordinary shares 6,000 rand, and application allotment preference shares it's going to be 50,000 rand. And what are we going to credit? We're going to credit bank, because now money is leaving our bank account. We are paying back that money to unsuccessful applicants. So here's the calculations if you want to make sense of it. For oversubscription of ordinary shares 6,000 rand, and oversubscription of preference shares 50,000 rand, and the journal entry is going to look like this. We put down our date, and what is that? That is the 5th of November, because we're told any surplus applications were refunded on the 5th of November 2023. So we put down the date of the refunds, and we debit what I've just mentioned, application allotment for both classes of shares, and we credit bank because money is leaving our bank account. And the narration there is repayment of surplus application funds. I hope that was easy enough. If you know the steps that you are supposed to follow, if you can take note of it, then it will make your life quite easy when you're dealing with this transaction. Now let's look at the scenario where you have undersubscription, where unfortunately you didn't have enough applications for your shares. What do you do then? Well, let's look at the example. So what are we dealing with when we are talking about undersubscription? Well, as we have already explained, undersubscription of shares occurs when the number of shares applied for is less than the number of shares offered. And so you will find that we'll issue a certain number of shares, and then the applications for those shares are less. We don't receive applications for all the shares that we have offered for issue. Companies typically evaluate if a share offer will attract enough interest. If they anticipate a possible undersubscription, they take steps to mitigate the expected shortfall by underwriting the share offer. And so that's where underwriters fees or underwriters cost comes in, and I'm sure you would have come across it if you're dealing with the issue of shares to the public. If you are thinking that possibly we may not receive enough applications for the shares that we are issuing and we need the funds for whatever the case may be, then we can underwrite the share offer. So what do we mean by underwriting, and who are the underwriters who will be underwriting the share offer? Well, underwriters are entities or individuals, often financial institutions or specialized firms, and listed by a company. So the company that is issuing the shares, that is, to mitigate the risk of undersubscription during a share offering. Their role involves guaranteeing the sale of shares in case the demand from investors is lower than the total shares offered by the company. And so you're getting the underwriters to guarantee you that you will get application for all the shares that you are offering to the public. underwriters commit to purchasing any unsold shares or make arrangements to ensure that the shortfall in subscriptions is covered. And so the risk is moving from the company to the underwriters, because the underwriters will guarantee us that even if the shares are not all taken up by the public, either the underwriters will take up the shares themselves or will make arrangements to ensure that all the shares are finally issued. And that is why a company would contract a underwriter in this case. By doing so, underwriters provide a form of financial insurance to the company, ensuring that the share offering is fully subscribed and reducing the risk of the company not raising the intended capital due to undersubscription. As we've already mentioned, that is clearly obvious there. You want to make sure that you will receive the funds that you are requesting for and that all shares are finally issued. And that is where the underwriters would come in. So whenever you have a case of undersubscription and you have contracted an underwriter, you know that all the shares will be issued. Even if the public doesn't take up all the shares, the underwriters will take up the unsold shares. So let's look at an example here where we have a case of undersubscription. Here we go. We are asked to record the above transactions in the general ledger of Sheligo Limited. Dates and narrations are required. Now remember the steps that we had mentioned. We are going to remember those steps and we're going to apply them here as well. Remember, the scenario doesn't matter whether it's an oversubscription or undersubscription. You still need to apply those steps, and they're easy if you know those steps and you know what to do when you're given a scenario. So let's read what the information tells us. Sheligo Limited's authorized share capital comprises 600,000 ordinary shares at 200 each and 350,000 10% preference shares. On 1 November 2023, an agreement was made with an underwriter and an offer on a prospectus for 400,000 ordinary shares at 1 Rand per share and 200,000 10% preference shares at 5 Rand per share was made. So this agreement was made with an underwriter that we're issuing 400,000 ordinary shares and 200,000 preference shares at their respective prices. The underwriter's commission was set at 4%, and the settlement of the underwriter's account was due on November 22, 2023. Now, if you know the accrual rule of accounting, we record transactions when they take place, not necessarily when there is movement of money. If you'd like to understand more on that, you can have a look at our lessons on accounting for beginners. We'll put the link in the description below if you'd like to understand the timing of recording transactions. But what we are saying is that whenever you've made an agreement with an underwriter at that point in time, you have created an obligation that you will pay the underwriter the fees that you will agree upon. And in this case, it's the 4%. So you're going to record on the date of the agreement, right? The 1st of November. But we'll look at that just now. Let's continue reading. By 10 November 2023, the company received applications for 370,000 ordinary shares at 1 Rand per share and 185,000 10% preference shares at 5 Rand per share. So you can clearly see this is an undersubscription of the shares. We wanted the public to buy up the 400,000 ordinary shares, but they only bought 370,000. And for preference shares, wanted them to take up 200,000 and they only took up 185,000 Rand. So here we have a case of an undersubscription. All right, but remember, we have an underwriter here who's going to ensure that all the shares are taken up. On 15 November 2023, the allotment of shares to all applicants, including the underwriter, was completed. The underwriter's account was settled on November 22, 2023, according to the agreement. Additionally, on November 29, 2023, the company incurred and paid share issue costs totaling 10,000 Rand. Okay, so let's record the above transactions. The first date that we are given here is the 1st of November. And as I mentioned, you've made an agreement with an underwriter. You've created an obligation. So you owe the underwriter the fees here. So we need to do the journal entry for the 1st of November. So what are we going to debit? What are we going to credit? And what is the amount? Well, firstly, let's look at the amount. How much do we owe this underwriter? How do we do the calculation? Well, it's quite easy. The question we need to ask ourselves is, how much money do we intend to receive by issuing these shares to the public? And then we take that amount of money, the total amount of money we expect to receive for all classes of shares, and we multiply it by the percentage that we have to pay the underwriter for incurring the risk. All right, so we're going to calculate that by taking the 400,000 ordinary shares multiplied by 1 Rand per share, and we take the 200,000 preference shares multiplied by 5 Rand per share, and the total of the two multiplied by the 4% will give us how much we owe this underwriter. Remember, this is the 1st of November. We're not paying the underwriter on that date. In fact, we're told later on that we're only paying the underwriter on the 22nd of November 2023. All right, so we are just creating the obligation here, or the liability. So here is the calculation. We take the 400,000 ordinary shares multiplied by 1 rand plus the 200,000 preference shares multiplied by 5 rand, and then that total will multiply by 4%, and it will give us 56,000 rand. So that is the amount that we need to pay the underwriter. Okay, so now that we know that it's 56,000 rand, what is our debit and what is our credit? Well, we are told here that underwriter's commission was set at 4%. So we're going to debit the expense because we owe the underwriter on that day. So we're going to create a debit underwriter's commission, that is an expense account, and then we're going to credit the liability, that is the underwriter. Okay, so our date is the 1st of November 2023, and the debit day is underwriter's commission, and our credit is underwriter. Okay, so we have our debit and our credit, and the amount, of course, we've just calculated it, 56,000 rand, and the narration there is 4% underwriter's commission due. All right, we put that due because we are creating this liability that we are going to pay later on. So we can see here we record transactions as they are taking place. Okay, so in the steps that we had initially alluded to, that we had gone through, it didn't have anything to do with underwriter. It just says when do we record transactions as they take place with regard to the issue of shares. But in the case where you have an underwriter, the day you sign the contract or you agree with the underwriter that you will pay them a specific percentage, that's the date you create the liability. Okay, when next do we have a transaction? Well, we've done the 1st of November, and we're told that we're going to settle the underwriter on the 22nd of November. So let's go chronologically, right? So let's go from the earliest date all the way to the last date. We're told that by the 10th of November 2023, the company received applications. So this should be easy. From the previous example that we went through, you record it the exact same way. We're recording how much we received for our application for each class of shares, and of course that's how much money is coming into our bank account. So you know we're going to debit bank. So we're going to put the 10th of November, debit bank, and then we're going to credit the application and allotment with each class of shares, ordinary shares and preference shares. All right, and the total amount that we're going to receive for this application is, of course, 370,000 ordinary shares times 1 rand and 185,000 preference shares times 5 rand. So we're going to move a bit quicker here because it's something you should know from the previous example. So that's how it's going to look, and we've got 1,295,000 rand. That's how much is going to come into our bank account. So that's what we're going to debit, and we're going to credit application and allotment, ordinary shares and preference shares. So that's exactly what we're going to do here. Put our date, very important, and then put our debit and our credit. For ordinary shares, it's the 370,000 times 1 rand, which gives you 370,000 rand, and for preference shares, it's the 185,000 times 5 rand, which gives you 925,000 rand. And the narration there is payments received for share applications. All right, easy as that. Next, we have the 15th of November, where we are told that on this day, the allotment of shares to all applicants, including the underwriter, was completed. So we issued all the shares. So here we need to be careful as to how many journal entries we're going to do. Remember, we are allotting shares not only to the applicants, but also the underwriter who assumed the risk for the shares that was not taken up by the public. That's why we're paying them a commission to assume that risk. It's insurance for us, as we had gone through in the previous slide. Okay, so we're going to start by allotting the shares to all the applicants. It's very easy. It's the same as the previous example that we went through. We debit application and allotment for both ordinary and preference shares, and then we credit each class of shares, ordinary shares and preference shares. So that's exactly what we're going to do on the 15th of November, the date at which we are allotting the shares to the applicants. We debit application and allotment for both ordinary and preference shares, and then we credit ordinary share capital and preference share capital with their respective totals. Okay, and the narration here is allotment of shares to the public. Now, we've just done the first part of the allotment. Remember, we also allotted the shares to the underwriter, as we are told it was completed on the 15th of November. So we need to show that in the journal entry. So what are we going to do? Well, if you look at the first journal entry here, we created a liability of 56,000 rand as the 4% that we owe this underwriter. But now we're going to debit the underwriter. Whenever you allot the shares to the underwriter, you debit the underwriter. So what that's going to do is that it's going to reduce or completely eliminate how much we owe the underwriter. Here's what that means. We have credited underwriter 56,000 rand. That is a liability. It means we owe the underwriter 56,000 rand. But now the first question we need to ask ourselves is, how many shares were not taken up by the public? Because That is going to be the responsibility of the underwriter to ensure that we get the money for those shares and issue the shares to the underwriter. So we need to calculate that. Well, we had offered 400,000 ordinary shares, but we only received application for 370,000 ordinary shares. So if we take the 400,000 shares minus the 370,000 shares and we multiply that by 1 rand per share, we've got 30,000 rand. So we still need 30,000 rand, and the underwriter is the one to pay us that money, and then we'll allot the shares to them. Okay, what about preference shares? We had offered 200,000 shares, but we only received application for 185,000 shares. So we take 200,000 minus 185,000 and then we multiply that by 5 rand per share, and it gives us an amount of 75,000 rand. So we need to receive 30,000 for ordinary shares and 75,000 for preference shares from the underwriter. Okay, so what are we going to do? We're going to debit underwriter with the total of the two, and then we're going to credit ordinary share capital 30,000 rand and preference share capital 75,000 rand. So basically what we've just done is allotted the share to the underwriter. So let's do just that. Put our date, debit underwriter 105,000 rand, and that is the total of the ordinary share capital and the preference share capital that we've put on the credit side. And the narration there, issue to the underwriter for shares not taken up by the public. Okay, and now that we have just issued the share to the underwriter, you can see on the credit side we owe the underwriter 56,000 rand, but on the debit side, the underwriter basically owes us 105,000 rand. Okay, so the difference between the two is what the underwriter needs to pay us. Okay, so if the amount was less than 56,000 rand, then we would need to pay the underwriter the balance, but since it's more than what we owe the underwriter, then the underwriter will need to pay us the balance. Make sense? Hope it does. And when did that happen? When are we paying the underwriter, or when is the underwriter paying us? Well, you can see from this that the underwriter's commission was set at 4%, and the settlement of the underwriter's account was due on the 22nd of February 2023. So it didn't, of course, clearly indicate who paid whom here, but we know that the underwriter owes us, and we're going to take that as the date at which the underwriter paid us, because the account was settled on that date. The underwriter's account was settled on that day as it was due. But in addition to that, we're also told at the bottom here that the underwriter's account was settled on November 22, 2023, according to the agreement. So the underwriter owes us the difference of 105,000 rand and the 56,000 rand. So we're going to debit bank because the underwriter is paying us in this instance, and then we're going to credit underwriter. And this is how it's going to look. The 22nd of November, we debit bank with 49,000 rand, which is the 105,000 rand minus the 56,000 rand, and then we credit underwriter. All right, and the narration there is cash received in settlement of underwriter's accounts. Okay, so I hope that has made sense. I hope that was clear enough. Your scenario might be that you still owe the underwriter even after allotting the share to the underwriter, and so in this case you would debit underwriter and credit bank, but you just need to be careful as to who owes whom in this case. Okay, so I hope that was clear enough. Now, the last line that we're given here, we're told that additionally, on November 29th, 2023, the company incurred and paid share issue costs totaling 10,000 rand. So how do you journalize share issue costs here? What are share issue costs? Well, as the name suggests, share issue costs are the costs that you incurred as a result of issuing shares. Now, IAS 32 states that when you incur share issue costs, it must be set off against the equity account. Okay, it doesn't state which equity account you must set it off against. Okay, so you may set it off against ordinary share capital, preference share capital, or whatever equity account you deem to be most reasonable. IAS 32 doesn't tell you which one to set it off against. Okay, so we're going to set it off against ordinary share capital. Now, the only time you put share issue cost as an expense is when you have abandoned the share issue altogether and you've still incurred the share issue costs. Okay, so when you've abandoned the share issue altogether, then what will happen is that you will debit share issue cost and credit bank. Okay, and that's the most obvious one. You may be thinking, but since IAS 32 states that it must be offset against an equity account, we're going to offset it against the ordinary share capital. So what do? Remember, we credit our ordinary share capital ordinarily, but in this case we're going to debit it to reduce our ordinary share capital with 10,000 rand, and then we credit bank, of course, because we paid that amount on the 29th of November. So this is how it's going to look. 29 November 2023, debit ordinary share capital. Whenever you see ordinary share capital on the debit side, you know you are reducing your ordinary share capital, and we are crediting bank with 10,000 rand. What is the narration? Share issue costs paid deducted from equity, as we are required to do according to IAS 32. Okay, I hope that last one also made sense. I hope you've gained value from this lesson. I hope you now know all about the issue of shares, to incorporators, to the public where you have oversubscription, and also where you have under subscription. If you gained value from this lesson, consider subscribing to our channel, like this video, and share it to those you think it might help. Till next time, cheers.